This is a replacement problem example. So a lot of times when we work in things like IT departments, or if we're working in a manufacturing environment, we have to replace an asset. So whether it's an old computer or an assembly line, we have to sort of bring out the old and bring in the new, right? And when we do this, it creates a cash flow. And it's almost like trading in a car. If you were to go to buy a new car today, you'd probably trade in your old one. And if you think about the cash flow, trading in your old car sort of reduces the net price of the new car. And that's what we want to think about here. So when we replace an asset, we'd like to calculate the cash flow we get when we sell off the old asset. And that's a net salvage value. So here's an example. So take a moment and read through the Win Inc. example. So hit pause, and then we'll begin working it. So this problem wants two things from us. It wants to know the net cost of the new computer system, and then it wants the annual cash flow associated with the purchase of the new computer system. So we'll work through one item at a time. First, we'll look at the net cost or initial investment to get the new system going. So essentially, I'm going to buy a new computer system for $130,000. It's going to require an additional $30,000 for installation. So that's my depreciable basis, $130,000 plus $30,000, or $160,000 is the cost of the new computer. However, when I buy the new computer, my old computer is no longer needed. So I can sell my old system for $20,000. Now that's a market value. So we're going to need to go through and calculate the net salvage value from selling the old computer. So let's do that now. Here's our typical cash flow equation. So here we're impacted by the gross PPE, and then we're going to add back the net salvage value of replaced assets. Now keep in mind that's a positive impact for us. It reduces the net cost because it's a cash flow in. So here's our calculations. Here's our depreciable basis of $160,000. They tell us the old computer can be sold for $20,000. That's its market value. And it has a book value of 0 since it says it's been fully depreciated. Remember, fully depreciated means we've taken all the depreciation we can take. So we go directly to the net salvage value. So remember, a net salvage value is market value minus taxes, and the taxes are determined by the tax rate times the gain or loss from selling the asset. Well, here we sell the asset for $20,000, and it's worth 0 in our books, so our gain is $20,000 that we're taxed on. We're taxed at a rate of 40%. So 40% of $20,000 is $8,000, and our taxes, of course, would be $8,000. Our net salvage value, therefore, then, is the $20,000 we sell the old computer for minus the $8,000 in taxes, and we net $12,000. So we go and spend $160,000 on a new computer, but we can sell the old for $12,000, so our net cash flow would be, we're out $148,000. There's no other cash flows really to think about here. So that's our answer to part A. Now let's move to part B. When we replace an asset, we're always sort of thinking in incremental terms. Right? So what changes from going from the old asset to the new asset? Well, here it says sales will increase by $32,000 and it will cut expenses by $2,000. We also need to look at the change in depreciation. So we had an old rate of depreciation with the old computer, and we'll be able to depreciate the new computer for a new amount every year. So we want that change. So on an incremental basis, those are our numbers. Our depreciation is simply the depreciable basis for the new computer divided by its useful life of 10 years, which translates to $16,000 per year. Now, this is kind of a technical or difficult topic, but if the old computer did have some depreciation left, we would say new minus old here. It's always what changes as a result of my decision. Well, if we said no to this new computer, we'd still have the old computer to depreciate. Now, the problem gets simplified here because it's fully depreciated already, so there is no depreciation. So our incremental depreciation here is just $16,000. You may want to listen to this a couple of times to get it because it's kind of an advanced idea. So we plug our numbers into our free cash flow equation. Now notice it's plus $2,000 on the expense part of the equation because we've reduced expenses. So basically it's a negative minus a negative. So that becomes a positive.